special presentation presented by Accountants World. We're going to be listening today to Rakesh Bhargava, Managing Partner at Mango Tree Real Estate Holdings, and Jimmy Atkinson, Entrepreneur and Investor. They'll be speaking on how to cut your client's capital gains tax cost, specifically on getting started with Opportunity Zone investing. I want to thank all of you for joining us today. My name is Div Bansali. I'm a Vice President at Accountants World, and we're thrilled to be hosting Rakesh and his guest speakers over the course of a 6-webinar series. Today is the kickoff event for this series, and it's really dedicated to helping you and your clients be able to better manage capital gains tax expense. Before I turn it over, a couple of quick housekeeping items. Number one, on the GoToWebinar control panel, if you don't see the control panel, look for the orange arrow that allows you to expand or hide the panel. You can change your audio options by clicking on the audio tab and then pick computer audio or phone call. And if you have any questions, you can go ahead and submit them using the questions tab. Make sure to click submit or click send, and those will come through to us, and we can get through those as well. We do offer 0.5 CP for each of the 6 sessions, so you can earn up to, with the exception of one, actually, I should say. So you can earn up to 2.5 CP throughout the course of this 6 webinar series. So in order to earn CP, you need to attend the live webinar. There's a 30-minute presentation. You need to respond to the polling questions today, and then you need to submit the post-webinar survey after the webinar has ended. Also, just wanted to, if you don't see any information coming from us about CP or about the webinars, make sure to add webinar@accountantsworld.com to your trusted email list on whatever email server you use. So at this time, I'd like to go ahead and turn it over to our guests today, Jimmy Atkinson and Rakesh Bhargava.
Hi, good afternoon and good morning, everyone. This is Rakesh Bhargava. I'm very pleased to report that Jimmy Atkinson is our first guest on this 6-part series. Jimmy founded a phenomenal website or a portal called opportunitydb.com, and they have now 55 podcasts on that website, which is an ocean or a profound source of information about Opportunity Zone. It has many good write-ups, good summaries, and good links. So Jimmy, welcome to this webinar, and thank you, Dev, for such a wonderful start and this opportunity to be in front of all these people. Jimmy, why did you start this Opportunity Zone DB, and how did you come to know that this is such a great program? How was your journey like, and where are you today with this program?
Yeah, well, first of all, I want to say thank you to Div, and thank you to you, Rakesh. Thank you to Accountants World, and thanks to all the attendees here today for taking some time out of your day to join us. So yeah, Rakesh, to answer your question, my background is actually not in tax accounting or in real estate. I have a background in economics and internet marketing, and I first learned about the Opportunity Zone program when I was listening to a podcast that featured Steve Glickman, one of the architects of the program and the founder of the Economic Innovation Group, which spearheaded the effort to get the Opportunity Zones included in the legislation. Listened to that last summer, and started up Opportunity DB and the Opportunity Zones podcast, one of the premier media properties in that space, in my opinion. I started that up in August of 2018, so going on a little over a year now of learning about the program and educating others about the tax incentive. So Rakesh, if you'd like me to continue, I'm ready to go here. Or
actually, if I could just jump in for a second,
yes,
Rakesh, would you like me to go ahead and do the first poll question now?
I think that's a great idea, Dave. Yes.
All right,
thanks for that introduction.
Okay, so let me go ahead and get the first poll question up. And so folks, you should be seeing your first poll question, and a reminder, this is required in order to earn CP credit today. So how familiar are you with the 3 Opportunity Zones tax incentives: defer, reduce, eliminate? 4 choices there. Please select one of those 4 options and then click the submit button. And so we'll give about 20 seconds here for folks to go ahead and read their options and select. All right, looks like the vast majority of you have voted at this point. 90% have voted, so we'll take just 5 seconds. Please get in your vote if you haven't already done so. Going once, going twice. Okay, so Rakesh and Jimmy, we see 45% of people say I'd like to learn more. 22% are not familiar. 27% are familiar but haven't started investing. 6% are already taking advantage.
Right. This is interesting. So, Jimmy, walk us through some of the major milestones in this legislation, please.
Sure, of course. Div, if you wouldn't mind turning it back over to me. Great, thank you. So first of all, I just want to address that poll. It's good to see that this may be review for some of you, but for the majority of you, it looks like you're not really working with opportunity zones yet. So happy to go into it in more detail here. So yes, to answer your question, Rakesh, some opportunity zones milestone. Opportunity zone tax incentive was a very small part of that big Tax Cuts and Jobs Act that was passed in December of 2017. And the way it worked is it allowed the governors of every state, plus the mayor of Washington, D.C., and the governors of the overseas territories, including Puerto Rico, to nominate low-income census tracts as specially designated opportunity zones. That process was underway in spring of last year and was finalized by Treasury when they certified all of those nominated low-income census tracts as opportunity zones in July of last year. The IRS guidance on this incentive is still ongoing. We didn't receive our first set of IRS regulatory guidance until October of 2018, about a year ago. We received a second set of clarifying guidance this past spring and April, and they're still yet to kind of merge those two tranches of regulatory guidance into a final set of guidance that should come by the end of this year. But there are still some outstanding questions. You should just be aware that the regulations are still kind of a moving target with some, in some respects. Some opportunity zone facts and figures now. I'm not sure, Sharon, if we had a poll question we wanted to ask before we got this one going or not, or Div, if we had that poll question, or if you want me to continue here.
No, I think you should continue, Jimmy. Yep.
Okay, let's continue then. So opportunity zones, there's 8,764 of them. They're spread out throughout the nation. I'll get to a map on the next slide, but it covers about 12% of the landmass of the United States, and 35 million people live in these low-income census tracts that are designated as opportunity zones. There's roughly $6.1 trillion of unrealized, unrecognized capital gains sitting on the books of individuals and corporations that are eligible to be invested in this program. Again, this is a capital gains tax incentive. That $6.1 trillion figure are capital gains unrealized as of the end of 2017. So that number has likely ballooned up since then as the stock market has gone up. The Treasury Department has said that they expect $100 billion to flow into this program over its lifetime, which would dwarf a lot of other tax incentives. My website, the Opportunity Database, lists over 100 qualified opportunity funds targeting $35 billion already, and there are likely hundreds more beyond that that are not publicly raising outside capital that are not actively marketing themselves. So this is a very large program. Here's the map. As you can see, the zones are spread out throughout the country. They are in rural areas, they are in urban areas, they are basically everywhere. Apologies to Alaska and Hawaii, they didn't make my crop here, but there are opportunity zones in Alaska and Hawaii as well. And if you notice down here in the bottom right-hand corner, this is Puerto Rico, this dark area here. And Puerto Rico was allowed a special exemption to designate 100% of their low-income census tracts as opportunity zones, whereas the rest of the country, the governors of each state were only able to designate up to 25% of their low-income census tracts. Right. So essentially, yes, go ahead, Rakesh.
Right. Now, Jimmy, one of the things that I want to point out about the map, and I'm not sure how true it is, but I heard that somebody bought a property looking at a map and it found out that this property was not in the right census tract. So maybe one thing that you and I can do after this podcast is the webinar is to find the IRS approved website and maybe include that link so that everybody can get the benefit of being the right location, so to speak. Jimmy, there's a lot of talk about the trifecta tax cards or the triple tax benefit is being touted as something that never been in history of America. This has been given. Tell us a little bit more about that.
Of course, yeah. So you're absolutely right. This is a once in a generation tax benefit where you can exclude all capital gains. I'll get to that momentarily here, but again, just to reiterate, this is a capital gains tax incentive, and it applies to capital gains invested in opportunity zones via qualified opportunity funds after December 31, 2017. I would just want to point out that that date is important. I have people who come to me all the time who ask me, hey, I've been in this property or in this business, in this opportunity zone for many years, and it's a little bit more difficult for them to be eligible for the program. There are ways around it, but for the most part, this applies to new money coming into zones after 2017. So there's basically three main tax benefits. The first benefit is a deferral. You get a deferral period on your initial capital gain. You can defer that capital gain tax liability until December 31, 2026. The second main benefit is a reduction benefit. You get to reduce your initial capital gain via basis step-ups on the initial capital gain by 10% and 15%, depending on how long your holding period is in the opportunity zone. I'll go over that in more detail in a moment. And then the third benefit, and this is really the biggest one here and why this incentive is receiving so much attention, is the elimination of all capital gains within your opportunity zone investment, tax-free growth essentially, so long as you hit a 10-year holding period. So I'd like to go through an example now because I feel like that's always the best way to introduce this concept to people. So for example, let's say you have a client, a taxpayer, has a $10 million capital gain, and we're going to assume a 20% capital gains tax rate just to keep the math simple. I'm ignoring the 3.8% net income investment tax, and I'm assuming a long-term gain rate of 20%, although I should point out that this program also does apply to short-term capital gains as well, which has a higher rate. But just to make the math simple, 20%, normally that would mean a $2 million tax liability due the following April. But instead, your client or the investor, the taxpayer, within 180 days of that gain recognition, rolls over that $10 million into a qualified opportunity fund. And the first benefit that he'll receive is a deferral period, which I like to equate to essentially being a $2 million interest-free loan from the federal government for 7 years. And you can imagine that you have to, the time value of money there and the fact that there's more compounding of more money within that investment actually makes it worth more than just a $2 million interest-free loan. There's more money behind that, essentially. Important to note that the tax on that gain does eventually come home to roost. It does come due in 2026. So your client will need some liquidity at that point in time. And the risk there is that tax rates could rise. The tax rate applied to that gain will be the tax rate in effect in 2026. And we don't know what that's going to be. Right now it's 20%, but there's obviously a good chance that that rate could go up by 2026, something to keep in mind. Benefit number two is the reduction in tax liability on the original gain in the form of two basis step-ups. So you have that $10 million capital gain, and this depends on the holding period. If you're able to achieve a 5-year holding period, you're able to reduce your tax liability on that initial gain by 10%. At a 7-year holding period, you can step it up by 15%. Now, those holding periods have to be achieved prior to the end of 2026. So if you do the math really quickly on those, you can see that 2019 and 2021 are key years. 2019, the end of 2019 coming up here in about 90 days or so, this is the last chance that you have, that taxpayers have, to achieve the full benefit of this tax incentive to get the full 15% basis step up. Now, the 10% basis step up is still a carrot dangling out there through the end of 2021, so that's important to keep in mind. But in our example, $2 million tax liability essentially gets reduced by 15% on December 31, 2026. And now instead of a $2 million liability, it's $1.7 million. Again, I'm assuming that the tax rate remains 20%, and that's something that you need to keep in mind, that that may not be true. We don't know what the tax rate is going to be in 2026. And also, as I mentioned before, the investor should have some liquidity when that gain becomes due. But this is really what the big tax benefit is the elimination of capital gains on appreciation within the opportunity zones investment. You pay zero tax on the appreciation assuming that you're able to achieve a holding period of at least 10 years. So for instance, if that $10 million investment appreciates to $40 million, or excuse me, appreciates to $50 million, you'd have a $40 million capital gain. That's normally a very large tax bill. But in this case, since you were invested in a qualified opportunity fund that checked all the boxes, met all the compliance, you pay $0 so long as your gain is recognized via a sale by the end of 2047 is the date that the IRS has currently pegged as the end of this program.
Right. So Jimmy, interestingly, two things that you made, which are 180 days you had to invest the money in QOF, but then there's another provision that within 180 days you need to invest in QOZBP. So technically, that's another 180 days that people need to be aware of. Am I right?
Yeah, that's correct. That's getting a little bit
I
technical,
know,
and
I'm getting
I'm
deeper,
hoping.
but because you mentioned 180, I thought I'll just throw that also in it. Second thing, Jimmy, is that people have to have hold it for 10 years. So if they invested in today, then 10 years starts from the date of their investment, and then they need to dispose of before December 31st, 2047, right?
That's correct, although I have heard some people say that this question is actually somewhat open to interpretation still as to whether or not you can hold beyond 2047 and possibly do a step up to fair market value at the end of 2047. I think the IRS has yet to completely clarify that point, so the jury's still out on that one, I guess
Got you.
I should say, yeah.
And also, all the attendees, please throw in your questions. We have Jimmy and I have budgeted some time at the end, so we will, or if you have any questions on what Jimmy is presenting so far, feel free to type it in, and we'll definitely ask Jimmy. So, Jimmy, another thing that people have been talking a lot about is comparing this OZ investment with the 1031 exchange. You have experience in that, and also new market tax credit. Can you tell us a little bit about that?
Yes, yeah, so I will do that. Let's start with the 1031 exchange first. The Opportunity Zones program has been referred to by some people as essentially a 1031 for stocks. And in some ways they're right, and in some ways that's not exactly right, because there are a lot of differences between the two programs. There's some similarities, of course, the abatement of tax essentially at the end. But I'll just go through these line by line here. So the 1031 exchange obviously is a like kind exchange, whereas the Opportunity Zones can apply to any capital gain. Sale of stock, sale of business, sale of real estate, sale of art, pretty much anything under the sun. It's much less restrictive in that way. The 1031 exchange only applies to real estate, whereas investment in Opportunity Zones can take place in the form of real estate or business or both. Probably the biggest difference between the two is if you have a client who has experience doing 1031 exchanges, what's the number one rule in real estate? Location, 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 right? There's no geographic restriction on 1031 exchanges. Suddenly that gets thrown out the window when you're dealing with Opportunity Zones. This is a place-based policy, and you're going to be investing primarily in low-income census tracts in these Opportunity Zones that have been designated as such. So that is a deal breaker for a lot of people there, just kind of moving away from the comfort zone with the locations that they're used to. So something to keep in mind. A 1031 exchange has to go through a qualified intermediary, whereas the Opportunity Zones go through what are referred to as qualified opportunity funds, a new investment vehicle that was set up exclusively for this tax incentive. And those funds are self-certified, meaning anybody can start one. Your client, your taxpayer can start one. It's just a one-page form to self-certify, to self-elect essentially as a qualified opportunity fund. The 1031 exchange, obviously, this is the big one too. The benefit only kicks in at death to the heirs, whereas Opportunity Zones has benefits at the 5, 7, and 10-year periods, as I've already discussed. Let's talk about how Opportunity Zones compare to new markets tax credits now. So you may have some clients who do some real estate development. They may likely be well-versed in new markets tax credits. I'll tell you right now, the big take home here is I think Opportunity Zones is going to dwarf the amount of capital that's going to flow as opposed in comparison to new markets tax credits. And this is the reason why. The new markets tax credits is capped at $3.5 billion per year, whereas with Opportunity Zones, there's virtually no cap. There's that $6.1 trillion figure that I cited at the beginning of the presentation. and it comes from private capital. It's not administered by any federal authority. There's just private capital that's flowing in. It is regulated by the IRS, and as I mentioned, the QOFs, or the Qualified Opportunity Funds, self-certified, but there's a lot less bureaucracy, a lot less red tape you have to cut through. There's no approval program. There's no application or approval process to get funds. It's merely electing to be a Qualified Opportunity Fund, and then it's on you to raise the capital from private investors.
Jimmy, thank you for that. So we have some questions coming in, and I think it's a good idea for me to ask you those questions. So one of the things that you and I discussed while we were preparing for this webinar is, what about the states? I mean, how many states in US are conforming and following the federal guidelines?
Oh, that's a great question. Yes. So I wish I had had that slide here, because I had that in a different presentation, but there are 39 states in the United States either do not have a capital gains tax rate or are already conforming to the federal incentive. Now, there are 11 states, California being the big one out there, that do not conform to this tax incentive. So in the case of California, I'll use them as an example because their tax rate's so ridiculously large at 13.3% for the highest tax bracket. You may have a client that can go through and check all the boxes to receive the federal tax benefit, but just make sure that you're aware of the fact that should he have a tax liability in California, he's not going to be able to escape those capital gains tax liabilities because California is currently not conforming. They do have some legislation pending that would partially conform for certain types of projects. I believe off the top of my head, if I'm remembering correctly, they would apply to green tech business and affordable housing. But if you just wanted to start just a manufacturing business or do hotel real estate development in an opportunity zone in California, you would achieve the federal tax benefits, but you would not achieve the California tax benefits. And there's 11 states still outstanding that do not conform.
Right. And also, Jimmy, another point that I've heard on one of your podcasts is that you can stack these benefits. So new market tax credit can be stacked on top of the opportunity. Even though that's not a question, that's something I heard on one of your podcasts. Is that true, right?
Yes, that's right. I'll go back to the new markets tax credit slide here. But yeah, so a lot of people are stacking multiple tax benefits. Like you say, the opportunity zones is just one tool in a real estate developers or business entrepreneurs or fundraisers tool belt to bring capital into his capital stack. But he can also pair that with new markets tax credits. He can pair it with low income housing tax credit, with historic tax credits. So, you know, oftentimes these opportunity zones will overlap with LIHTC and HTC.
Right.
So yes, there are people who are taking advantage of that and are twinning multiple programs, allowing them, you know, to draw capital from multiple sources.
Right. And Jimmy, the other question that come up talks about the can someone invest in these inside of an IRA? So before I ask you that question or have you answer it, neither Jimmy nor I are tax accountant or tax attorneys. Based on our experience, we may be able to answer the question. So can this investment be made inside an IRA? Which I doubt is. I think you're already tax deferred anyway.
Yeah, that's a good, you know, I don't know the answer to that question, Rakesh. I would defer that to a CPA to answer that.
Okay, so we have attorneys coming up in the next couple of sessions, so I'll make it a point to get that question answered.
Yes.
Second question is, the holder of a QAF, does it need to have an office inside inside a census tract that's an opportunity zone?
Does the QAF need to have an office inside of an opportunity zone?
Right.
That's a good question. In some cases, you may be able to have an underlying qualified opportunity zone business that has a location inside of an opportunity zone. I don't know that but to answer your question, no, the QAF itself does not need to be administered within an opportunity zone. Simply its underlying assets or a certain percentage of its underlying assets need to be located within an opportunity zone.
Right.
I would say, before we go on to the next one, I would just say largely it depends on what the QOF is doing, but assuming that it has enough assets and enough headcount within the opportunity zone, the QOF administration itself may or may not need to be located inside of an opportunity zone.
Right. And Jimmy, I think that if there is a two-tier structure, one is the QOF and the other is the underlying QOZBP, which is Qualified Opportunity Zone Business Property, then QOZBP, if they are taking deduction as a business enterprise, they need to be within the QOF.
Yes, that's correct. Yeah,
Okay.
yeah.
By the way, somebody answered from Grand Rapids, Patrick, that you are correct. QOF does not need to be located in QOZ. So thank you, Patrick.
That's correct.
Okay, Jimmy, a couple of other quick question. Number one is that you have met an awful lot of people while you're doing this interviews and 55 podcast. What's your take on these benefits? What's going on with them? What's the ground reality? Because there's a lot of negative press on these.
Yeah, so a lot of thoughts there. I'll try to distill it down as efficiently as I can because I know we're running short on time here, but the reality is this is a very complex program, and it's very early on in the program also. I know there was a New York Times article, front page New York Times article that came out end of August that was largely critical of the program, and I think it was right to be critical of the program because so far we haven't really seen a lot of capital flowing to projects that are going to make a large impact. That said, I would counter by saying we're very early in the ball game here. I think we're in the top of the first inning in terms of how much impact the opportunity zones benefit can have. The impact is hard to gauge. One headwind is that the incentive faces is the complexity of it, and there's a great need for educating not only individual investors, but their accountants as well, which is why I'm glad we have so many people here today listening on the call. And I do think that over time, as accountants and as other advisors and as investors become more and more familiar with the program and more comfortable with the program, more capital will flow. I also think that as the IRS finally clarifies their final set of regulations, that will help unlock a lot of capital also flowing not only to real estate to build that infrastructure in these low-income communities, but then behind that real estate in business startups and operating businesses that will be the source of economic development and job creation. So I do think that there's great opportunity here to do a lot of good in these low-income communities.
A great response. Now, let me ask Dave to throw in the second poll question at this point, because we are just about 2 minutes away from it. And then Jimmy, I have one more very important question to ask you that somebody just asked me online.
All right, so I've got the second poll question up right now. So folks, you can go ahead and vote, and the question is how many opportunity zones are there? And so there are 3 options there, so please select the option you believe to be the correct answer. Make sure to hit the send button or submit button so that your vote is counted. And just a reminder that voting in the poll is required in order to eventually earn CP credit. All right, so we're going to take about 5 to 10 seconds here. So if you haven't voted yet, please go ahead and do so. All right, we are going once, going twice. Okay. So 81% of people said 8,764, Rakesh.
That's a correct answer, and congratulations to everyone. Jimmy, one last question. Well, I was talking to you earlier about this webinar. I noticed that you have a new entity called OSI Pros. So I want you to tell a little bit about it, number one. And so maybe you can start with that, and then I have one final question for you.
Sure. So OSI Pros was created as to solve the problem that real estate developers and business entrepreneurs, a lot of your clients out there, for those listening, have no experience or very little experience creating and managing funds. So we have set up ozpros.com to help you create opportunity zone funds, to create qualified opportunity zone businesses, those QOZBs. And for the accountants out there, we help you create an audit trail and compliance to make sure that these funds and the underlying QOZBs are doing everything the right way. We have templates for a 31-month business plan that's required in the regulations for a pro forma for those who are looking to raise capital. We also have an OZ compliance checklist that I think a lot of accountants and fund managers will find helpful. And if you want to visit ozpros.com/bonus, after you get off, we can send you some of our promotional material. We have a beginner's guide to opportunity zones, which is a free PDF download. You'll also get on our weekly email newsletter. And OZ Pros has not yet launched, but when we do, we'll remember you and we'll send you a little coupon code to get you started.
Okay, so Jimmy, we are entitled to a discount on this website. Am I correct?
That's correct, yes.
I appreciate it. Thank you so much, Jimmy, for being so generous. Dev and Accountants World team, Sharon, everybody, thank you so much for great help. I want to thank Barkha, my associate, who helped me put this together. Those who attended, thank you so much. This is a great program. It's gonna, if we all do our part correctly, it will be a great benefit to those who are not as fortunate as we are. And we hope everybody has a great rest of the day. Thank you, Jimmy, again.
Great, thank you guys. And just wanted to remind everyone, the next webinar in this series will be 2 weeks from today, October 21st. Rakesh will be joined by Mark Walensky talking about legal structures for investing in opportunity zones. So that'll be another 30-minute session. So gentlemen, thank you so much for your time today. And Rakesh, look forward to seeing you again in 2 weeks.
Sure. Thank you, everybody.